Uh, people think cash is safe. They keep their money in savings accounts earning maybe 1% interest, and they feel secure. They think, at least I'm not losing money. But here's the truth. Cash isn't safe. Over time, cash is one of the riskiest things you can hold, because even if the number in your account stays the same, the purchasing power of that cash shrinks every year. Inflation is the invisible thief that robs cash holders blind. Right now, as we wrap up 2025, the annual inflation rate in the US is about 2.7%, according to the Bureau of Labor Statistics. If your savings account pays 1%, you're losing around 1.7% of your purchasing power every year. Your money is shrinking in real terms. Over 10 years at that kind of inflation, your $100,000 can only buy what about $76,000 could buy today. You've lost nearly a quarter of your wealth just by holding cash, and you barely notice because the number looks the same. I've been saying this for decades. Cash is trash in an inflationary environment. It's a terrible store of value, and yet people hold enormous amounts of cash because they're afraid of risk, afraid of volatility, afraid of losing money. But they don't understand that holding cash is losing money slowly, steadily, inevitably. I've always believed in saving like a pessimist, but investing like an optimist. Keep some cash for tough times, but don't let it sit there rotting away. Put it to work in things that can grow and beat inflation. We've seen inflation fluctuate from spikes in the early 2022 when it hit over 9% due to supply chain disruptions and post-pandemic recovery to this more moderate 2.7% now. But the principle remains, cash erodes silently. Groceries, housing, energy costs all creep up, and your dollar buys less. I've seen this globally too, where hyperinflation in parts of Africa or South America wipes out savings overnight. Even in the US, with the Federal Reserve trying to keep inflation in check through interest rate adjustments, that 2.7% adds up, compounded over time, and it's devastating. People stash away millions thinking they're secure, but they're not building wealth. They're watching it fade. I learned this through my own journey, from dropping out of Harvard to start Microsoft in 1975, betting on personal computing when most people thought it was a hobby. That optimism paid off. But I always kept reserves to weather storms like the dot-com bust or the 2008 financial crisis. Today, through Cascade and the Gates Foundation Trust, I manage billions, and cash is only a small temporary part, never the core. So today I want to talk about 10 assets that are better and more secure than cash. Assets that protect your wealth, assets that grow over time instead of shrinking. These aren't speculations, and they aren't get-rich-quick schemes. They're time-tested stores of value that have preserved and grown wealth for decades, even centuries. If you're holding too much cash right now, you need to hear this. I built my fortune not by hoarding cash, but by investing in things that create value, innovate, and adapt. Through the Bill and Melinda Gates Foundation, we've poured billions into global health and education, but personally, my investing is about long-term stability and growth, focusing on companies and assets that solve real-world problems. I'll draw from experiences like how Microsoft adapted to inflation by innovating and expanding, and how farmland holdings have provided steady returns amid economic shifts. The first asset, and maybe the best of all, is ownership in great businesses through stocks. When you buy stock, you're not buying a piece of paper or a ticker symbol. You're buying a piece of a real business that makes products or provides services and generates profits. Take Microsoft, the company I co-founded with Paul Allen. It's an ecosystem powering billions of devices, cloud services like Azure that businesses rely on worldwide. and AI innovations through partnerships like OpenAI that are shaping the future. We grew from a small startup in Albuquerque to a trillion-dollar enterprise by constantly adapting. A great business can raise prices when inflation hits. If costs go up by 2.7%, it can adjust, whether that's subscription fees for Office 365 or cloud computing rates. It passes inflation on to customers while continuing to innovate. Your cash can't do that. Your savings account can't raise its interest rate to match inflation. But a great business adjusts, survives, and thrives. And great businesses grow over time. They expand into new markets like gaming with Xbox or healthcare through data analytics, becoming more profitable. That means you're protected against inflation and you're building wealth through growth. Historically, the S&P 500 has returned about 10% annually over the long term, even after inflation going back to 1,927. As of December 2025, it's hovering around 6,800 to 6,900, up significantly from the start of the year despite volatility from elections and global tensions. If you had put $100,000 into an S&P 500 index fund 30 years ago, you'd have about $1.7 million today. If you invested at the beginning of 2025 when it was around 5,000, you'd already be looking at strong gains, maybe 30 to 40% in a great year, despite dips. Meanwhile, cash would be losing purchasing power. The stocks are volatile. They go up and down, sometimes sharply, like 2008 when markets fell about 50%, or the 2020 pandemic dip that recovered quickly. But over 10, 20, 30 years, they've consistently outperformed cash and protected against inflation. Tech companies like Apple or Amazon compounded at 20 to 30% annual rates for long stretches. I've kept a big chunk in Microsoft stock because I believe in its pipeline, from AI like Copilot to quantum computing research. But diversification matters. In the Gates Foundation Trust, as of Q3 2025, we hold about $36.6 billion across 23 stocks, focused on stable, innovative companies. That's asset one. Asset two is Treasury inflation-protected securities, TIPS. These are U.S. government bonds where the principal adjusts with inflation. If inflation is 2.7%, your principal rises 2.7%, and you earn interest on that adjusted amount. It's a direct inflation hedge designed so you don't lose purchasing power. Returns are modest. Real yields might be around 1 to 2% above inflation, like 5-year TIPS yielding about 1.5% real in late 2025. But that's far better than cash quietly shrinking. In uncertain times, with trade tensions and geopolitical risks in 2025, TIPS provide stability, backed by the full faith and credit of the U.S. government, which has never defaulted. You can buy them through treasurydirect.gov or through ETFs like iShares TIPS. That's asset two. Asset three is real estate that generates rental income, income-producing real estate. Rental income tends to rise with inflation, and property often appreciates over time. Historically, U.S. home prices averaged about 4 to 5% annual growth, outpacing inflation. And in 2025, some markets like Texas and Florida saw 5 to 7% appreciation due to population shifts. If you buy a $200,000 rental producing $20,000 net a year, that's a 10% return. 10 years later, with inflation around 2.5 to 3%, the property might be worth about $270,000, and rents might rise to around $27,000 if you adjust leases annually. Meanwhile, $200,000 in cash stays $200,000 nominally, but buys far less. Maybe what $150,000 bought before. Real estate takes work, tenants, repairs, taxes, and insurance, but the cash flow and inflation protection beat cash. You can also use REITs if you don't want direct management. That's asset three. Asset four is high-quality dividend-paying stocks. These companies pay cash regularly and often raise dividends every year. Think Coca-Cola, Johnson & Johnson, Procter & Gamble, and dividend aristocrats that have raised payouts for decades. Their dividends can grow faster than inflation because they can raise prices on essential products. In 2025, you see examples like Hormel with a long streak of increases, Merck yielding around 3%, and utilities like UGI. In my portfolio, Canadian National Railway pays dividends with a yield around 2% and grows that dividend by about 7 to 10% annually. Dividend growth compounds. Dividends buy more shares, which pay more dividends, creating a snowball. A stock yielding 3% with dividends growing 7% annually can turn into about 6% yield on cost in 10 years, about 12% in 20 years, and about 23% in 30 years. Holdings like Waste Management provide reliable dividends from essential services. That's asset 4. Asset 5 is your own skills and education. It's not in a brokerage account, but it's incredibly valuable. Investing in yourself increases earning power, and earning power is one of your greatest assets. If you earn $50,000 a year and spend $5,000 to learn a skill that raises your income to $60,000, that's a 200% return in the first year alone, and you earn that extra $10,000 every year. Skills can't be inflated away. I dropped out of Harvard, but I never stopped learning, reading over 50 books a year. That learning helped me spot opportunities in software and later in philanthropy. The foundation has invested over $5 billion in U.S. education since 2000. Globally, education raises earnings, and with AI reshaping jobs, adaptability and lifelong learning matter more than ever. That's asset 5. Asset 6 is a diversified portfolio of index funds. For most people, this is the smartest approach. Low fees, broad diversification, no need to pick winners. Fees can be as low as 0.03% for an S&P 500 fund. Historically, the market rises because businesses innovate, serve customers, and generate profits. If you're sitting on $100,000, earning 1%, moving most of it into a low-cost index fund while keeping an emergency cushion changes your future. Over 30 years, $100,000 at 10% becomes over $1, $7 million, while at 1% it becomes about $134,000. And that's before inflation. Avoid trying to time the market, dollar cost average and hold. That's asset 6. Asset 7 is productive assets like farmland or income generating equipment. I own over 275,000 acres of farmland across the US. Not because I farm, but because farmland produces crops and income, and the land can appreciate. I began investing in it around 2013 through Cascade because it's a real asset that can't be printed, tied to productivity, and supported by growing food demand. Productive assets create value. Factories produce goods. Trucks generate logistics. Revenue. Equipment enables work. Most people can't buy a farm the way I can, but you can own productive assets through businesses that hold them or specialized REITs. That's asset 7. Asset 8 is precious metals, especially gold and silver. I'm not a huge gold fan because it doesn't produce anything, but it has served as a store of value for thousands of years and can protect during severe inflation or currency stress. In 2025, gold surged nearly 70%, reaching over $4,470 per ounce amid tariff uncertainty, central bank buying, and inflation fears. Silver also rose, helped by industrial demand in electronics and solar panels. I see precious metals as insurance, maybe 5 to 10% of wealth, not the core, possibly via ETFs like GLD or SLV. That's asset 8. Asset 9 is ownership in a business you control, starting or buying a business and running it. It requires work, and most businesses fail, but the returns can be enormous, and you can raise prices and adapt as inflation shifts. I started Microsoft with Paul Allen in 1975, dropping out of Harvard, focusing on software when many people doubted personal computing. Today, starting a business can be easier with modern tools, but it still requires learning, iteration, and resilience. Through Breakthrough Energy, I've invested in many startups because controlled businesses can drive innovation. That's asset 9. Asset 10 is your health and longevity. It might sound unusual, but health is a real asset. When you're healthy, you can work longer, earn more, and avoid major medical costs. Poor health brings expenses, lost income, and reduced quality of life. Investing in health through diet, exercise, and preventive care pays returns that compound over decades. The foundation has invested over $50 billion in global health since 2000, fighting diseases and improving nutrition because healthy populations drive growth. Personally, at 70, I'm still working, investing, and building impact, in part because I've taken reasonable care of my health. That's asset 10. Now, am I saying you should hold no cash? No. You need cash for emergencies, opportunities, and peace of mind. We keep significant cash and short-term treasuries as dry powder to deploy when opportunities appear, especially during downturns. But that cash is temporary. It's not long-term wealth. For individuals, keep 3 to 6 months of expenses in cash. Beyond that, deploy money into productive assets, index funds, dividend stocks. Some tips for stability, maybe real estate. Don't let excess cash sit in a savings account, losing purchasing power year after year. Cash feels safe because the number doesn't change, but that safety is an illusion. The real value is declining. The true risk isn't volatility, it's losing purchasing power. If you're holding more than you need for emergencies and short-term needs, you're choosing the illusion of safety over real security. I understand the fear. What if the market drops right after you invest? What if you need money unexpectedly? But what's more likely is inflation continues at 2 to 3% and your cash keeps losing value. 10 years from now, you may realize you missed huge compounding by staying in cash. I've watched smart, successful people do this for decades. They save diligently, keep it in cash, earning little, and years later they're comfortable but not wealthy because they never put money to work. So take your excess cash and deploy it. Start simple with index funds, add dividend stocks, use tips for inflation protection, build a diversified portfolio, be patient, and let compounding do what it does. Businesses can raise prices, innovate, and grow. Cash can't. Cash is a tool for transactions and short-term needs. It's not a store of value over the long run in an inflationary environment. Real stores of value are the 10 assets we covered. Businesses, inflation-protected bonds, income-producing real estate, dividend growth, skills and education, index funds, productive assets like farmland, precious metals as insurance, businesses you control, and health. So make the decision today. Look at your cash, decide what you truly need for emergencies, and invest the rest in assets that protect and grow purchasing power. Don't wait for perfect timing. Don't wait until you understand everything. Start small, learn, and keep going. Every day you hold excess cash is a day you lose purchasing power. Every year you wait is a year of compound growth. You miss. The best time to stop holding too much cash was 10 years ago. The second best time is right now. Thank you for watching. Now go put your money to work, start investing today, and secure your future. Good luck.